Hey, good morning. This is Jim Harvey, president of Opus 111 Group, and this is your Money Week for the week of March 13th. And I'm dating this because over the weekend we had some major bank failures, and it's raised a lot of questions in people's heads about, are we signaling a rerun of the great financial crisis because we had some pretty significant bank failures. Starting on Friday and extending over the weekend, we saw two very large bank failures, Silicon Valley Bank and Signature Bank. That followed the collapse last week of Silvergate, the so-called crypto bank. These are some of the largest bank failures in US history, and they all happened in the past several days. So the question is, what is going on here, and could we be headed for the next great financial crisis? The bottom line is the situation is something to keep an eye on, but it is not the start of the next financial crisis. Unlike in 2008, the government has stepped in early and stepped in hard. While we can certainly expect market turbulence, and we're seeing that this morning, the systemic effects will be limited. We are not set for a rerun of the great financial crisis, and this is not the end of the world. Instead, the takeaway so far is that regulators and the feds are on the case and are willing and able to support the financial system. Sunday night, the US Treasury announced that depositors will be fully protected in the interest of maintaining systemic confidence, and that the funds were being made available to support banks under stress. Unlike in 2008, the government is getting ahead of the problem rather than trying to clean it up afterwards. To me, that's a very positive sign. So given all that, what's going on and what does this mean for our investments? Well, many people have written good descriptions of how and why these banks collapse, and I don't see any reason to replicate that. As investors, the why is interesting, but we need to know what it all means for the future. And this is what we know now. First, I think it means that a recession is more likely. The rise in interest rates engineered by the Fed is indeed affecting the financial system. While the effects on the assets of Silicon Valley Bank were more intense, other banks are wrestling with the same problem. So expect to see banks in the financial sector as a whole pull back on lending and risk until they get their houses in order, and this will slow economic growth and likely put markets down. In some respects, that's good. It is what the Fed has been aiming for, but it makes a recession much more likely, quite possibly in the short term. On the other hand, the question isn't whether a recession is more likely. We've been talking about that for months. The question is, will it be a profound recession? And I think the answer is no way. First of all, we have full employment. Normally in a recession, you'd be talking about unemployment at 8-10%. And it's still considered full employment and it's less than 4%. Secondly, savings rate in the US is high, and because people are working, that means they have money. And our economy is based on consumer spending, and so people are working, that means they spend money. So again, it's going to affect corporate earnings, but it won't affect the economy as a whole. A second development has to do with tech. Second, the fact that the collapses have principally been in the tech and crypto spaces suggests that these sectors are even at more risk than the economy as a whole. Now, we saw that last year with so many of the big 5 tech companies that dominated the S&P having really substantially negative years. I think the best one was Microsoft down 34, and the worst was Tesla down 57. While other banks will move to replace Silicon Valley Bank, they will not be as focused or as dedicated to that sector, to the tech sector, and that will slow things down going forward. One of the primary enablers of the tech boom is now gone. Now, both of these are reasonable outcomes. They also are ones that we have not only seen before, but we were expecting. The real question, though, is whether these bank failures signal a wider systemic problem. And here, the news is good. So some good news. First, 3 things caused the financial system to lock up in 2008. Number one, a lack of transparency around asset values, particularly leverage, causing a lack of liquidity for those assets. Number two, a lack of sufficient capital by the banks to weather a crisis, and those reserve requirements have changed. And number three, a lack of available credit in the early stages of the crisis to support them until liquidity came back. We are in a very different place now on all 3 of those fronts. For the assets, US banks now largely hold very liquid assets dominated by US Treasury notes. Those values are clear and there's a large market for them. In fact, they're the most liquid in the world. Banks can raise cash if they need to, simply by selling or borrowing against those assets. Second, U.S. banks are by and large very well capitalized. They have the money to weather storms and, as noted earlier, can access it, which are both very different than what happened in 2008. The third part is where we have to be careful. Banks have seen those treasury notes decline in value significantly as rates rose, and there are questions in some cases whether the value of the bank capital still covers all the liabilities. This is what drove the collapse of Silicon Valley Bank. What the Treasury did Sunday, however, was to solve the problem by providing a way for banks to borrow against long-term assets like treasuries based on the par value, not the current value. That largely eliminated the insolvency problem and provide the credit that was missing in 2008. Will not eliminate the problem. The banks still may need to rebuild their capital bases, but it will allow the banks some time to recover, which is a key piece of the rebalancing of the system. So in other words, this is not another crisis, but there's going to be more turbulence. Compared to 2008, the system is more transparent with more solid foundation, and the government has identified the remaining problems and put programs in place to deal with them. From a depositor standpoint, the decision by the government to stand behind all the deposits also reduced the risks of further bank runs. With a more solid system and the government being aggressively proactive, as of right now, there looks to be little systemic risks in place. We won't see another great financial crisis. We will, however, see continued turbulence. Even though the systems will hold, investors need to figure out the effects of all of this. Expect a bumpy ride, but it's a ride we will all eventually be able to get off of. The story is not over. We don't fully know how it will end. We do know, however, that we will make it through. So keep calm and carry on. Hope you've enjoyed this. We invite you to go to our website, and particularly the Learn page, and where you will see written and audio and video blogs educating you on this and other items in the hope that you can make more informed and more relaxed decisions about your money. Thanks. This is Jim Harvey. Have a good day.